Some of the highest yielding stocks in the market are not REITs or dividend aristocrats, but rather they're BDCs, aka business development companies. Their high dividend yield comes with a degree of risk unless you know what you're doing and you pick the right ones. You guys asked, and I listened. In this video, we're going to be ranking the 15 most popular BDCs against one another to see which ones belong in our portfolios. And through my ranking system, we will see which ones are poo-poo and disgusting, and other ones that are going to be fantastic. S tier will be a dividend compounder with cheese, a beautiful BDC, and F tier all the way at the bottom is going to be kind of like your wife's boyfriend changing your kid's last name to his. A terrible and miserable situation. And we're going to grade the BDCs into a letter category based on their dividend profile, their net asset value situation, is it growing year over year, and then of course their performance in the stock market. Each one of these categories are going to have an equal weighting of 33% in the decision-making process to keep things as objective as possible. And if you want to understand why we use those metrics when it comes to BDCs, then you should watch my video on what to look out for in a BDC. And there's going to be a total of 15 BDCs that we're going to be assessing and ranking in this video. Now, this video might be controversial because the market and I might not see eye to eye when it comes to identifying a dividend compounder with cheese. If we see that it's ugly and its finances are yucky, then I'm going to categorize them into the D or E. I'm not going to be shy about it. But I'm also the same kind of guy who just started to play soccer in his mid-30s. So I live my life on the edge. I don't care. So let's go ahead and get into it. The first one is going to be Capital Southwest, ticker symbol CSWC. And what you see on the right side of your screen right now is the breakdown of their portfolio allocation to what businesses they help service and mentor. As you can see, the biggest slice of the pie is going to be healthcare services, food, agriculture, and beverage, consumer products. So it seems like they're pretty big on tangible physical stuff instead of software or technology. That's something to keep in mind. But also, as we look at these portfolios for all of the different BDCs, you should know that the assessment of the portfolio itself is going to be really subjective, because if the numbers look good, then the numbers are good. So even if I feel bearish towards one sector or industry having a lot of weight in their portfolio, it doesn't matter. What matters is the outcome. Are they producing results? Are the businesses that they're invested into growing at a double-digit rate? If it is, it doesn't matter. And when we take into consideration their loan mix, 89.2% of the loans that they hand out to the businesses that come through their doors are first lien investments, which I would argue is pretty good. Because the golden standard when it comes to BDCs, you don't want to see this number right here any less than 75%, unless the design and nature of their BDC has an entirely different priority and mission set where they do not do first lien investments. But for the most part, I would argue like 99% of the companies that we're going to be talking about here today, they do first lien investments as their focal point, because this one is the most important. To see 89%, pretty good. When it comes to Capital Southwest, they have an internal management model, which means they have better alignment with the shareholders, they have lower operational expenses, and their compensation incentive are usually based on NAV per share growth. All that to say, not always, don't be that wise guy, not always, but for the most part, their dividend is a little more secure and capable of long-term growth because there's less fees going out the door for externally managed teams. So the first thing we're going to be looking at is the NAV per share. And Capital Southwest has been publicly traded on the stock market for so many years. They went through a lot of stock splits. And so whenever I went to the websites, their NAV per share breakdown is all wonky. So I had to manually do it through my own spreadsheet to see what is going on. And if you want a copy of this, it's available on the Patreon. But anyways, when we take a look at their NAV per share in 2018, it was $19.25. The reason why I'm highlighting this is because I want to see what were their operations like prior to the pandemic and all of the associated disruption. Right? So they were thriving at $19.25. I would argue that is really good. However, look at what happened even prior to the pandemic in 2019. It dropped down by negative 5.9%. We'll round up and say negative 6%. And then during the pandemic, they went through the worst storm ever. Because in 2019, their NAV per share was effectively $15.11. That's a decline of negative 16% year over year. And so what I'm doing right now is looking at the bigger picture, because as we assess this past fiscal year of 2024, their NAV per share is now $16.80. When you think about it, you would think that it's amazing for Capital Southwest to increase it from $15 to $16.80. But when you look at it with a bird's eye view, you can see that it used to be $19.25. So when it comes to their NAV per share, this is not a good picture. And the reason why, some of you have asked me, I wanted to answer it right here. Some of you have asked, and when I say some, I literally mean one person. Why don't I look at data past 20, 30 years more holistically? And that's because when it comes to businesses, especially those in the stock market, so much of their DNA, their mission, their operation, their economic mode, so much can change in 5 to 10 years. So for me, I don't really like to take into consideration data that goes beyond 10 years because it's not the same company that they were 15 or even 40 years ago. Case in point, when you think about Intel, back in 2014, Intel was one of the most beautiful dividend compounders with cheese that you can think of. And then in 2021, we started to see the problem in their business, which is they stopped innovating. They took it too easy, they played it safe, they stopped taking calculated risks, and now look at what happened to Intel. And on the flip side, a company that used to struggle for a majority of their company history, but for the past 5 years or so, they're now a darling, a compounder that the stock market loves, is Crocs. Believe it or not, Crocs, the shoe brand that's also the parent company of Hey Dudes, they actually trade for a single-digit trading multiple, and their financials look pretty solid. All that to say, if you want to look at a company's data from 30 years ago and ding them on stuff that happened 30 years ago, it's probably safe to say that they have learned their lesson, they have made adjustments, changed their leadership, vision, focal points, the corporate-wide standard operating procedures are all different and adjusted and modified. So there's my very long-winded explanation as to why I only like to look at data within the past 10 years. My one caveat is this, unless of course we're talking about the dividend history. If there's cuts, 13 years ago, 17 years ago, for me, I think that's a huge blemish that I just cannot ignore. It's like seeing someone that's absolutely beautiful, smart, they have the personality of a golden retriever, but unfortunately, they snore very loudly in their sleep. For me, that's a deal breaker. And I think to see that in their history for their dividend is not a good thing. Case in point, when we look at their dividend profile, right now their current dividend yield is 11.2%, which I would argue is phenomenal. That is beautiful. The golden standard when it comes to BDCs, you want to see a dividend yield of at least 8%. Because this is such a risky industry, I don't want to see anything less than 7%. If it's less than 7%, is it really worth the risk to be invested into this? I would rather just invest into a qualified dividend payer like Altria that also has a very high dividend but is also inherently more safe. Which means for every share of Capital Southwest that you own, you get paid out $2.52 a year in dividends. And as we scroll down to look at their dividend history in a visual format, this is beautiful. So I think they're making up ground for how ugly their NAV per share history is. These spikes right here are probably quarters where they performed too well, and so they had to pay out the rest of their taxable income out as dividends, or there was a special dividend thrown on top of their normal payout schedule. But I would argue this is really good. Case in point, in 2015, they used to pay out 3 pennies every 3 months, and now it's 63 cents every 3 months. So when we talk about Capital Southwest dividend picture, this is really good. I think they set the bar really high for what we want to see in a good and a juicy BDC. And now to evaluate the performance of Capital Southwest in the stock market, I'm on a platform that is primarily dedicated to BDCs, and I'll leave the link to this website in the video description. But anyways, what we're going to do right now is think about $10,000 invested into Capital Southwest, and we're going to compare it to the S&P 500 to see what we are working with. So in the exact same timeline of 1995 all the way up to 2025, when we take a look at their performance broken down year over year, the compound annual growth rate when you take into consideration dividends and the share buybacks, well, that is 14.8% every single year for Capital Southwest, meaning your money would have grown at a rate of 14% each year. On the other hand, when we look at the S&P 500, what we investors refer to as the market, your money would have grown at a rate of 10%, which is still respectable with a capital R. And when we look at the transformation of $10,000 invested into each vehicle, well, that 10 grand with Capital Southwest would have grown just a hair above $500,000 at $597,000. This is pretty darn impressive. For the S&P 500, that 10 grand would have been $175,000. It's still pretty good, but I think Capital Southwest has set the bar really high in terms of what we are looking for when it comes to a BDC. And as we go about the rest of this video, for the BDC and their performance, I'm really going to be focusing and emphasizing their performance year over year, because not every BDC that we're looking at here today have been on the stock market for the exact same timeline. So if we see one company grow $10,000 to like $400,000, it's not as impressive, because let's just go ahead and say another BDC was effectively able to turn 10 grand into, I don't know, $200,000 in the span of 2 years. Whereas the other company, to reach that 400 grand, it took them like 50 years. So when you look at it broken down year over year, you can kind of see the nuances and read between the lines. All things considered, when it comes to Capital Southwest, I thought their dividend profile was really awesome. Their performance in the stock market, also beautiful. However, their NAV per share growth year over year, atrocious. If it weren't for that blemish, they would honestly be an A or maybe even S tier. But because of that, I'm not going to turn a blind eye towards that fact. So as of right now, Capital Southwest for the time being is going to be categorized into the C tier. Now I can change my mind and make adjustments throughout the video, but as of right now, I think that's where they belong. Actually, that's a little rude. I think that's a little too aggressive and a little too strict as a grading teacher here. I think let's put Capital Southwest into B. Now let's move to the next company. The next BDC is Gladstone Capital, ticker symbol GLAD, otherwise known as GLAD. And I do want to call out that there's two different Gladstone BDCs. This one that we're looking at right now is the traditional BDC, whereas GAIN is the riskier version of this. Because for GAIN, aka Gladstone Investment Corporation, their focal point is buyouts. And that strategy for a BDC is just more inherently riskier. But anyways, what you see on your screen right now is their portfolio breakdown of the businesses that they help mentor and service. As you can see, they have the biggest allocation towards conglomerate manufacturing type of businesses and to the aerospace and defense sector. What I know is right now in the stock market, anything to do with the defense side of the economy, such as consulting firms or defense contractors, possess a bearish sentiment from Wall Street and other investors because of what's going on with the current presidential administration trying to cut the fat and trying to reduce our spending in the government expenses. So to see GLAD carve out 19.2% of their pie towards the aerospace and defense industry, it depends on who you ask, whether that's a ballsy gamble or if those businesses are going to struggle. And a minor adjustment that I want to make is I just lied. Their biggest pie slice is going to be the service conglomerates, and then it's going to be manufacturing at 22.9% right here, 20% right here, and aerospace and defense at 19%. And if you're wondering what kind of businesses work with Gladstone Capital, well, what you see on your screen right now are some of those companies. We have Zupas, which is a healthy fast casual restaurant chain. We have I-10 Defense, which seems to be a defense contracting type of company. And of course you have Inspire Aesthetics. They're basically a plastic surgery firm. So they're all over the place and they seem to be quite diversified in the business world. And something that I want to call out, when we look at their loan mix, this bar graph right here, all the way to the right, that's their most recent one, 69% of the portfolio is represented by first lien loans. This is not good. In a perfect world, I would like to see this number go up by at least 5%. To see it less than 70%, for me that's a red flag and not a good thing. Unlike Capital Southwest, GLAD is externally managed, meaning they bake in management fees that are taken out from the profits and reduce the full growth potential of the dividend. Because for external management, they have performance-based compensation. And the name of the game, I'm not saying all the time, but the name of the game is to make and acquire new investments at all costs. Which means the question that you want to ask yourself is, will this BDC always give loans to the best choices, or are they just handing it out because they want their fat end of the year bonus checks? That's something that you do want to keep in mind, but in terms of performance side by side, there's no big differences when it's internally managed or externally managed, but it is something to be mindful of, that the fees are coming out from the dividend growth and their profits. And when we take a look at their NAV per share, it's pretty disgusting, because back in 2005, it used to be $26 NAV per share, right? As you fast forward, it's just been declining almost quarter after quarter, year after year, up until they hit their lowest point in the pandemic. Since then, this company has been in the upswing, because it's going from $14 back in 2020 to what it is today at about $21 NAV per share. So if we only consider the past 5 years or so, then their NAV per share situation is phenomenal and beautiful, because it's growing in the right direction and overall it's just good. However, if you look at it more holistically and take into consideration how it used to be $27 back in 2005, then it's disgusting. I think for me, Gladstone went through bad management or a bad portfolio mix, and so as a result they suffered declining NAV per share for the most part, at least for the past 15 years or so. However, if you assess Gladstone with an optimistic hat on, then I guess it's a really good thing. So overall, I think I'm going to average it out to a C. The holistic picture is not good, but the recent history looks phenomenal. So I think that's fair to be a C for there. And when we take a look at their dividend profile, they hit the minimum dividend yield needed to be the golden standard. It's an 8% dividend yield, meaning for every share of Gladstone that you have, you get paid out $2.38 a year in dividends. I think this is pretty juicy, and I like it. And did you know their dividend payout frequency is every single month or every 30 days? For me, I think that's also a bonus. Whenever a company has their finances and operations in such fine order that they're able to calculate and forecast and pay out a dividend every 30 days, for me, that's a huge green flag. But we want to take a look at the history. As we scroll down and take a look at it visually, you can see that their dividend back in 2015 used to be 14 cents every single month. And as we fast forward, now you can expect about 16 cents every month. So in the big picture, yes, it did grow, but at a very tiny, insignificant rate. And I would even argue during the pandemic, their dividend was cut. It went from 14 cents every 30 days down to 13 cents. And then, as you can see right here, they exhibited a huge setback, and it went down to even 4 pennies every 30 days. However, upon further review, like a referee would do, it looks like in September they paid out their usual 16 cents. So when I take a look at this one, this was probably an additional dividend on top of the normal dividend that you can expect every month. So I take that back. When it comes to their dividend profile, I think this is pretty darn good. The growth isn't exactly the most excellent and attractive, but it is growing in the right trend when you look at it, at least for the last 10 years. And a mistake that I made with Capital Southwest is when we measured their performance, we looked at it all the way back to 1995. So I'm not going to do that. Instead, let's just look back for the past 10 years or so, because not only did they experience a bull market, they also experienced the pandemic correction and recession. So 2015 to 2025, and let's go ahead and compare it with the S&P 500 just for a sanity check, to have a benchmark. And anything you do in life, I think it's beneficial and tremendously helpful to do some A/B testing. That way you don't just stick with one method. If it is inefficient, you can see it right away. So with $10,000 invested, let's see what happened. With Glad and the dividends reinvested, that 10 grand would have transformed into $45,000. With the S&P 500, that would have been $34,000. This is pretty surprising to me. Did you know that the BDCs outperformed the S&P 500, especially when you reinvest the dividends? Man, this is an interesting thing to find out. And when we take a look at their CAGR year over year, your money would have grown at a rate of 16% every single year. For the S&P 500, for the past 10 years, that would have been 13%. Remember, the S&P 500 includes the giants like Nvidia, Microsoft, Google, Facebook, whereas Gladstone is just Gladstone. So this is really darn impressive. When it comes to their performance, I would also categorize this as an A or an S. And that's why earlier I mentioned that it's subjective to critique a BDC by their portfolio mix in terms of what businesses, sectors, and industries that they're involved in. Because if the bottom line and the growth is improving every single year, or in the big picture it's phenomenal, then it doesn't really matter who their clients are, as long as they're able to grow and pay their loans back on time. When it comes to Gladstone Capital, ticker symbol GLAD, I think their dividend profile looked phenomenal. Their performance was just really good. It brings tears to my eyes. However, the only category, the metric that was a hit or miss, depending on how you want to look at it, is their NAV per share growth year over year. So all things considered, I think Gladstone belongs right next to Capital Southwest in the B tier. I know that sounds diabolical, it sounds like a scandal. I feel like maybe they should be an A, but let's not get ahead of ourselves, because maybe there's going to be a BDC coming up where they have all three metrics in the green zone. So as of right now, let's keep Gladstone into the B tier, right next to Capital Southwest. And to make good on my mistake earlier, I wanted to do the exact same experiment from 2015 to 2025 for Capital Southwest, because maybe we're not looking at them correctly. And as you can see on your screen right now, $10,000 10 years ago would have transformed into $110,000 when it comes to Capital Southwest. So that changes things for how we should look at Capital Southwest. I don't think that they belong in the B tier anymore. Consequently, we're going to bump Capital Southwest up to the A tier. Is that fair? I feel like they earned it, because Gladstone, I think we were rocking with a 10 grand to 45,000, which is still good, but for 10 grand to turn into $110,000 is just out of this world. What is holding them back is their net asset value and the growth thereof. And before we go any further, I wanted to explain myself. Why am I making this video? Yes, you guys asked for it, you requested it, and yes, I'm making good on my promise, but I'm also doing this BDC ranking video because I currently do not have any BDCs in my portfolio. But knowing how good they are, knowing about their dividend income and the stability of it, I want to invest into one or maybe two someday. So by doing this video and doing this methodology, I can find out for myself which BDC is the best among them all. Which means, if you're listening, I have no skin in the game. So as you can see, I don't have any bias or favor for one BDC over another. Because the worst thing in the world is when I watch someone on YouTube or I listen to them and they just pump their own stocks again and again in every single tweet or video upload. I don't want to be that person that is always biased. Continuing on with the video, the next BDC is going to be Trinity Capital, ticker symbol TRIN. And as you can see on the left side of your screen, this is the breakdown of their portfolio and what they focus on. Trinity Capital primarily works with tech, life sciences, warehouses, and financial businesses. And as you can see their geographic breakdown, they favor those that are in the West Coast and on the Atlantic coast, like Virginia all the way up to Vermont and Maine. And what is really interesting about Trinity Capital are some of the businesses that are in their portfolio. Specifically, they have Whoop, which is a heart rate monitor that helps detect your oxygen levels and stress. I think this is something that is phenomenal and awesome as a product. So if I think very highly of the product itself, then I'm hoping that the operations and business behind it is awesome as well, because Trinity Capital is helping them out. As we scroll down, you can take a look at, they also help out Rocket Lab, Athletic Brewing Company. They also help out Shoulder Innovations. It's a anthroplasty-focused medical device company. They also help out a data analytics company when it comes to pharmacies and medical services. And before we talk about their NAV per share and the growth thereof, something that I do want to call out is that their IPO was back in 2021. So their history on the stock market is very short. And also they have internal management, which for me is a very slight green flag. When it comes to BDCs, and I'm looking at two of them, all else equal, I'll probably go with the one that's internally managed over the one that's externally managed. So on this screen right here, their history starts in September of 2020. However, on this screen right here, it says their IPO date was back back in 2021. So I guess it's just semantics of when they actually debuted in the stock market, but it doesn't really change anything. It's not like it's going from 50 years down to 5 years. It's literally changing from like 6 months to 9 months plus or minus when it comes to their stock market IPO. But whatever, I digress. $13 around the beginning of their company history. You fast forward throughout the years, what does it look like right now? It is also $13. So when we think about their assets, the loans and the equity value on their balance sheet, is it growing year over year in proportion to their shares outstanding? That's a big fat no. So when it comes to their NAV per share, this is not as ugly as the other ones where it declines severely. For Trinity, I would argue it's pretty flat. I don't think it's growing or declining. And when we take into consideration their performance on the stock market, for Trinity Capital, their 10 grand would have turned into $17,000 from 2021 all the way to 2025. For the S&P 500, that also would have been $17,000. And that's why it's really helpful to have a benchmark to compare your financials and your investment, potential investment too. So you can see, is it good? Is it bad? Does it pale in comparison? The year over year CAGR is 14.9%, which I would argue is pretty darn juicy. For the S&P 500, with the tech and the AI bubble and subsequent bull run, it is also 14.5%. So in terms of their performance, they did slightly edge out the market, but I also think being shy of 15% is phenomenal. So I think this is a really good thing. Yes, their history on the stock market is very short, but if this is the pace that they go at 14.9% year over year, I'd be more than happy. As we jump over to their dividend profile, right now they trade for about $15 a share, depending on when you watch this, which means the dividend yield is 13%. But remember, the high dividend yield is that way intentionally by design. If you don't know what I'm talking about, watch my video on what to look for when it comes to BDCs. I think I already gave a shout out to that. This is my second time. Anyways, which means for every share of Trinity Capital that you have, you get paid $2 every year in dividends. Pretty darn good. Do not look at this. This doesn't matter when it comes to a BDC. And when we look at their dividend history, I would argue it's not bad. I mean, yes, I would have liked to see this trend right here, 2022, all the way to the end. I guess all of 2022 for it to be increasing every single year, but it did decline from then, and now they're pretty much flat, but it's still a pretty phenomenal picture when you look at their debut of about 28 cents every 3 months. Now it's 51 cents. I would argue this is pretty good. Solid dividend profile, 13%. My goodness gracious. So I think when it comes to Trinity Capital, there's a lot to like here. The only thing that's holding them back is their NAV per share growth, because it was pretty much relatively flat, and their very short history on the stock market. And I say that because we don't really know what their business decision making is going to be when we go through a, 2-year bear market or a depression. But based on what we know and what we saw, their very short history, I think this is really phenomenal. Their performance, I would give it an A+, maybe even S tier. Their dividend profile is bonkers, but it seems to be good at 13%. So all things considered, I think Trinity Capital really ought to belong next to Capital Southwest. I know, we started out the video with a bang, and believe me when I say I've never heard of either one of these companies before I started researching and doing my homework to make this video. Because I think we all know about Main Street Capital or Ares Capital, and that's why I'm saving them for last. But I think these lesser known BDCs are hidden gems and they're underdogs because they're actually pretty darn good. All right, friends and family, I just got back in from taking my dogs out for a walk. I've been filming for an hour and 20 minutes now. But the next one is going to be Blackstone Secured Lending, ticker symbol BXSL. And what you see on your screen right now is their portfolio breakdown. They have a majority in the weight in software as a service, which makes a lot of sense to me because software has high margins without having overhead costs for physical assets. And then the next highest group is going to be healthcare providers and services at 10%. And then professional services, this one also has high margins. Their geographic location for their businesses spans across the US, Canada, and Europe. Surprisingly, about 7.8% of their businesses are based in Europe. And when we take a look at their loan mix, About 98.7% are first lien, which phenomenal. That's about as good as it gets when it comes to a BDC. This is absolutely beautiful. Unfortunately, they are externally managed. I'm sorry, that's biased. Let's just go ahead and say they're externally managed, whether that's a good or a bad thing. And as you can see on your screen right now, Blackstone has only been publicly traded since 2021, so their history is going to be short. But with that said, when we take a look at their NAV per share, finally, friends and family, we are talking. This is what we want to see in a BDC. So back in September of 2022, it was $25.76 a share. As you fast forward, look at it growing in the right trend. Blackstone is now currently at $27.27 when you consider their NAV per share. Blackstone, I just want to sincerely say thank you. I appreciate this. This is beautiful. And when we take into consideration their performance, the 10 grand would have been $17,000 in the same timeline from 2022 all the way to 2025. That breaks down annually to a CAGR of 28% for Blackstone. That is an absolute wild number to see coming from a BDC. And as you can see, the S&P 500 in the exact same time period was 25%. So they beat the market, and this number is not too crazy for the same time zone. But I gotta say, I am pleasantly pleased to see the results so far with Blackstone. And to keep my thoughts more organized, I decided to create the spreadsheet so we can keep track of what we are seeing. So the NAV per share, I would go ahead and say A. And then for their CAGR, it broke down to what, like 20-something%. But mind you, that is a very short sample size, and we don't know how they're gonna do, during like another pandemic, recession, or overall market correction. So this number right here is a little high, but it is what it is so far. And let me just go ahead and line all these to the right so that it's uniform and a little more presentable. They're currently trading for about $33 a share. The dividend yield is 9%. It's above my standard of 8%. So far, so good. And when we take a look at their dividend history, in the beginning, it looks like it was a little rocky, but upon further inspection, they pay their dividend every 3 months, right? So I think what's going on here is there's a January and a March. So I think they paid out a special dividend right before their actual dividend that happened right here, March 30th. This is their normal dividend that's supposed to happen on time, on schedule, 3 months after this one right here. So this right here and this right here, I think those were special additional dividends on top of the normal ones. So the dips right here, I'm not going to deduct points away from Blackstone. As a matter of fact, you're seeing that they give special dividends on top of the scheduled dividend that you can expect every 3 months. So when it comes to their dividend profile, the yield and the health of it, I think this is absolutely beautiful. So the dividend yield is 9.18%, and the dividend health, I would go ahead and say A. Now, something that you do want to keep in mind is that the history for Blackstone, just like Trinity Capital, very short. We don't know how they're going to perform in the long run, but what we know so far is that this company, friends and family, it is the first BDC of today to be categorized into D. No, I'm just playing with you. I am literally yanking on your left nipple. Blackstone is going to be the first S-tier BDC. I am surprised. I genuinely never have heard of this company. I thought at first it was BlackRock, but no, there's no affiliation with them. This is a company that came out of nowhere, a hidden gem, and that's what you can expect on this channel, and that's why I'm saying subscribe if you like this type of content. Blackstone, the first S-tier BDC. The next BDC is Hercules Capital, ticker symbol HTGC. What you see on your screen right now is their little disclaimer on the website, because Hercules is different and riskier, in my opinion, than the rest of the BDCs that we're talking about here today, because they issue venture debt. So you can associate Hercules with high risk and high reward, and they invest into the tech and life sciences space. Venture debt and venture lending, they basically do business with pre-IPO companies. And as you can see their loan breakdown, about 85% of their loans are categorized as first lien. So that is good, but they also do venture debt, which I feel icky about. But when you see the breakdown of their businesses, it looks like they predominantly do business on the West Coast with 3% exposure to the South, which I think is hilarious, which is probably companies based in Dallas, Austin, Houston, San Antonio, one of those big cities, or even New Orleans. And as I alluded to earlier, they really fancy businesses that are in the tech or life sciences space, and they are internally managed. Yes, you love to see it. And when we look at Hercules NAV per share, I can just categorize this as all over the place. Sometimes it goes up in a beautiful trend, and sometimes it goes down in a very prolonged period. And overall, I would say it's flat from about, 2005 is $11.71 to now it's about $11.40. So I would categorize this as a C, maybe even like a C minus for their NAV per share. And when we look at Hercules' performance in the stock market for the past 10 years, 10 grand would have transformed to 38,000. That did beat the S&P 500. They did 10,000, 34,000. So the compound annual growth rate, what I care about, is 14.3%. Pretty phenomenal. I think this is a really good thing to see. For the S&P 500, that was 13%. And their dividend profile is a 9% dividend yield. This is quite juicy, and you get paid $1.92 per year. Their schedule for dividends is every 3 months. When we scroll down to take a look at their history visually, it looks like 2015 all the way up until 2018 it was pretty flat. You could expect 31 cents every 3 months. But since then, it seems like the company has been growing because now we're talking about 48 cents every quarter. So all in all, when I take a look at their dividend history, I think this is closer to a B. Because my explanation is this: a company that is an A or an S should be growing throughout the ages in the right direction from start to finish. But when it comes to Hercules, we had this really long stagnated period of no growth, and then again we're seeing it from 2023 of August to now. It's just stuck. However, I do got to give credit where credit is due, because overall, big picture, it did go from 31 cents to 48 cents. So I think a B grade for their dividend is very fair for Hercules. And as we jump over to this spreadsheet right here, let's go ahead and fill it in. Their dividend yield was 9.08%. Their dividend health and the growth thereof, let's just go ahead and say a B. Not a plus, a B. I think when it comes to Hercules, they're going to be somewhere along a B or an A. For me, I think this is a perfect example of a company that's B+. Reason being is, I thought their NAV per share was not exactly what I wanted to see. I want to see a trend that is growing year over year, right? And that just wasn't the case. So if I could, I would have put Hercules right here in between A and a B, but look how messy and ugly it looks. Kind of like your wife's boyfriend, right? So we're just going to go ahead and bump them down to a B. I don't think they should belong next to Trinity or Capital Southwest. I don't think they're as good as them. The next BDC is New Mountain Finance Corporation, ticker symbol NMFC. Kind of sounds like the name of a football club. And this BDC is kind of interesting because their strategy, as you can see in the top left, they like to keep volatility in control by investing into acyclical sectors. So they have a very defensive growth strategy that really aligns with me as someone that is a value investor that has a low risk tolerance. And I love the fact that 12% of New Mountain's shares owners belong to the ones who work for the company. So they have incentives to see the success of the stock by doing the right things. And when you look at the breakdown of their portfolio of what kind of businesses they work with, it does seem like their biggest category is healthcare services and healthcare softwares. That is something to be mindful of. If you're bullish on the fact that a lot of Americans are getting older and living longer, that's going to require more healthcare services, right? So if you align with that belief, I think you're seeing eye to eye with New Mountain. However, when we take a look at their loan mix, I'm not in love with this. About 63% of their loans are first lien. This is disgusting. I don't like this. They need to bump this number up to where I can feel comfortable, at least a 70 or 75%. This one, not good. And something else to keep in mind is that New Mountain is externally managed. And as you can see on your screen right now, since 2011, I would argue New Mountain has been pretty much flat, meaning their stock price doesn't appreciate much. It went from what, $13.28 to what we are today at about $11.72. So when you think about it, your total return is basically their very high dividend yield of about 11% year after year, getting that 10 to 11% dividend yield while the stock price stays pretty much flat. It's not not the worst thing in the world. Along those lines, let's take a look at their dividend profile, an 11.6% dividend yield. Very juicy. I love what I see. When we scroll down and take a look at their dividend history, 10 years ago was about 34 cents every quarter. And as you fast forward, it did drop down to 30 cents during the pandemic. And then right here, oh, that was a special dividend because in December, they paid out their regular 36 cents and then a special one of 10 cents. So we can't deduct points from them for that. And now you get 33 cents every 3 months. If we zoom back out, it was 34 cents back then. So pretty much the dividend is not growing. However, you can certainly expect your yield on cost to be about 11.6% if you buy into New Mountain right now, because it seems like their history shows their stock price is not going to grow that much. And you're absolutely right. Past performance is not indicative of future gains, but is it crazy and out of this world to say that, 5 or 10 years from now, their stock price is pretty much going to be around $11 to maybe $13? It's not going to grow much. But on the other side, neither will their dividend. It's going to stay pretty much flat at about 11.6%. So the current dividend yield is 11.69%, which is pretty good, but it's not growing and it's pretty flat. So even though the yield is quite juicy, I think we're going to give it a grade of a C+. If they were growing the dividend payout year after year, then that possibly could have been an A, but a C+ for now. And as we take a look at their NAV per share, it's pretty much exactly like their dividend. It's pretty much flat. There's no growth. Sometimes it goes down, and sometimes it drops by a lot, but they do tend to recover. But overall, I would not say this is a pretty picture because back in 2011, it was $14.25, their NAV per share. In present day, we're talking about $12.62. The fact that it's flat and even on a decline, man, we just got to be truthful and say that's a D, possibly even a D-. But hopefully New Mountain can make it up with their stock market performance, which I don't know, friends and family. It's probably going to be a CAGR of about 11 to maybe 12%. Let's just see what happens. Past 10 years, when we compare it to the S&P 500, this is not good. 10 grand would have transformed into 21,000, and the year-over-year CAGR would have been 7.9%. This is not good. I mean, in the context of other stocks and in the big picture of the stock market, it's not bad. But from what we have seen so far with the BDCs, this pales in comparison. So their performance in the context of BDCs, I would label as trash. I would not even invite them over for a cookout dinner. This is not good. Not good enough for me. CAGR is 7.93%. Their NAV situation, I'm going to go ahead and say a D-, not D underscore, a D-. So am I a racist if I don't put New Mountain into this category of C? I don't think they're an average BDC. From what we saw, they underperformed the other BDCs by a huge margin, and their NAV per share wasn't a pretty picture. And their dividend, although the yield is juicy and predictable at about 11%, it's not growing. So I kind of want to put them here, but I feel like that's being, a drama queen and exaggerated. So I think New Mountain is the perfect example of a BDC that is an E+ or a D-. So we're just going to put them right here. Let's make them smaller so you can see everything. New Mountain Finance Corporation, D tier. Now I can feel it already. If you are invested into New Mountain, you're probably leaving me a very angry comment saying, "What do you know, you idiot? This is the best BDC. The fact that you forgot they do this and that." I get it. We get heated and upset when we're emotionally invested into our favorite stocks, but on this channel, we do things a little differently. We remove our emotions away from investments. That way, we invest into winners without allowing our psychology to cloud our judgment. That's exactly why I choose to invest into industries and sectors that I'm not the biggest fan of, but I know that they are a winning recipe. Likewise, if I'm invested into a company that I really like, but their mission and their trajectory and their economic moat dissipates and it's gone, and their future looks pretty bad, I'm not going to keep them. I'm going to sell them. Because if I don't remove my emotions and I choose to be in love with a company, then I'm going to be holding on to them while they go deeper into the red. red. Does that make sense? So by removing emotions, whether they're good or bad, it allows you to be a more objective and a long-term thinking type of investor that chooses to invest into good businesses rather than your emotional affiliation and how you feel about them. That shouldn't really matter. What should matter is their free cash flow growing year over year? Is the management team spectacular? Is the dividend history really impressive and growing year after year? Things like that. That should matter rather than I really like the way their shoes feel on my feet and I'm in love with this company. If you talk and think like that, you might not win in the stock market, which is a perfect time for me to say this. Before we go any further, I wanted to give a shout out to today's video sponsor, which are the folks on Patreon. If you enjoy the content and appreciate this YouTube channel, why not consider becoming a Patreon member? You'll get access to stuff that I do not post here on YouTube, and I'll give you a shout out in future uploads. Do it, or else I'll start posting yoga videos on TikTok and embarrass myself. The next BDC is going to be Oaktree Specialty Lending Corporation. When I first heard of Oaktree, it kind of reminded me of Howard Marks' investment firm, but they're not affiliated. When we take a look at their portfolio breakdown, I like what I see. About 19% are software as a service, very high margins. I like it. They also have a lot of exposure to the healthcare industry. Real estate is 5%. I think that's kind of healthy, not too bad. But when you add the fact that they have 4.8% specialty retail, then I don't know about that. To have over 10% exposure to real estate as a BDC, not a fan of that. As we scroll up to take a look at their loan breakdown, about 82% are first lien, which is pretty good. I did not like the businesses that they partner with, but let's see if the numbers will speak for themselves. And by the way, Oaktree is externally managed. Their NAV per share, big picture, I can see right off the bat. This is disgusting. I don't even think I need to break down how disgusting this is. I mean, right now it's $18 NAV per share, but if we zoom back out to 2008, it used to be $39.61. This is atrocious. Which, by the way, spoiler alert, because their NAV per share was so atrocious, we can already predict and forecast that their performance is probably going to be trash as well. Trash is just trash all around, right? So let's see what happens here. 10 grand would have transformed $17,000, same timeline as S&P 500, pales in comparison. This is disgusting, guys. The CAGR breaks down to 5.9%. This is pretty pitiful. I don't like what I see. I really don't like Oaktree. Do I even have to look at their dividend profile? I guess I have to be very thorough and detailed, but man, I don't like this BDC already. I thought their NAV per share was really bad, horrendous. I'm going to go ahead and say F. When we take a look at their dividend situation, right now it's a 13% dividend yield. They're trading for $16. I just want to see what happened to their stock price as well. I'm going to imagine it's declining. No, it's actually pretty much flat because back in 2020 it used to be $16 and now effectively it's still $16. That's pretty impressive and shocking to say the least. Now keep in mind, as of right now, they pay a dividend every quarter. However, as you can see on your screen right now, it looks like back in 2016 and early on in their history, they used to pay a dividend every single month. That's when probably their finances and operations were in order and things were impeccable and more predictable. Used to be 18 cents every month. And then they made the decision to transition into going into quarterly. And, surprisingly, their dividend situation is not bad at all. And objectively, I would even argue this is pretty good. However, let's just do some quick napkin math. If you times 18 cents by 3, that spits out about 54 cents every quarter. So it went from about 54 cents back in 2015 to about 2017 to now 28 cents per quarter. So when you look at it that way, that's why you got to read between the lines. When you look at it that way, man, I don't know. Their dividend yield is quite juicy, but the history and the growth and the health, not a good thing. So consequently, I think their numbers speak for themselves. Oaktree is just an S tier. No, I'm just kidding. They're definitely not S caliber. I think Oaktree, man, I'm trying to put them in between an E and an F. I don't know which one to go with so far. I think an F is a little too harsh for what we saw. It's not the worst BDC in the world. But I think right now, let's just go ahead and keep them an E for now as a standard for like what is ugly, what is disgusting, what is something that you want to close a door on. And if I remember at the end of the video, if everyone else was shining and much better than Oaktree, I think I am going to bump them down to an F if everyone else is better than them. Next BDC is going to be Goldman Sachs BDC. Easily, out of everything that we've seen so far, this is the most recognizable finance brand, and I would argue in the world. Everyone knows Goldman Sachs, for better or for worse. And I gotta say this, their investor presentation and the website, it looks like a website straight out of the early 2000s. It's very plain Jane. And when I think about it, it doesn't really bother me. Because would you rather want a company that is really flashy, colorful, and has an awesome website, but terrible finances, an unprofitable operational margin, and declining metrics year over year? I mean, I'm going to tell you this. I would rather want a company that has an ugly investor presentation that has like no color anywhere, but their numbers and their data and their revenue and their net income growing year after year. I would rather that, because early on in my investing journey, I fell for that trap. Right? I went for a company that had a charismatic CEO, their website, their investor presentation, so much color, so good, so engaging, so pleasing to the eye and aesthetic. But the company was fumbling their numbers, they were lying about their forecasts, and they eventually went belly up. And I learned that lesson the hard way. Do not judge a company off of surface value metrics of what you see on their website, of how plain it is or how colorful it is. Do not judge a book by its cover. Rather, judge it by its outcome, by their output, by their free cash flow, by their shares outstanding decreasing year after year. That's what you should evaluate a company on instead. So with that out of the way, let's take a look at Goldman Sachs. About 20% of their portfolio is in software as a service, which I love to see. Very high margins, very profitable, good thing. Second highest group is going to be healthcare, and then finance and professional services. I would categorize all three of these pretty similar at about 10%. And when we look at their loan mix, that's back on page 6, about 92% of their portfolio consists of first lien loans. This is really good. And when you include this number right here, then it jumps up to 97% first lien loans. As I said earlier, right? Goldman Sachs, prestigious financial company for a good reason. They understand that first lien loans are best in class. And when it comes to Goldman Sachs BDC, they are externally managed. Unfortunately, when it comes to their NAV per share, this is not good. It's a straight decline. I mean, I'm going to give Goldman Sachs this. It's pretty consistent and reliable, but it's going in the wrong direction. You want to see this growing, not declining year after year. So when it comes to their NAV per share, this is pretty bad, pretty atrocious. But let's see how their performance in the stock market went. It's loading. All right, 10 grand would have transformed into 16,000 in the exact same time period of the S&P 500. Wow, that is really bad, because the S&P 500 turned that into 34 grand. This is not good. Their CAGR breaks down to about 5.9%. So I don't know. Right now I'm taken aback, because I thought maybe the website is really trash and the presentation is really boring because the company focuses on the right stuff. But as it turns out, I don't even know if that's true. It seems like it's just trash all around. This is really bad in the context of a BDC. When it comes to their year-over-year CAGR, I think it's very similar to Oaktree at about 5.9%. So far, I'm going to say this does not look good for Goldman Sachs. But let's go ahead and take a look at their dividend profile before we conclude and jump to a decision. When we take a look at their dividend profile, their dividend yield is 14%, currently trading for about $12.84. Let me see what happened to their stock price, just out of curiosity. Past 5 years, it declined by 39%. It used to be around about $20 a share. Now you're lucky to see $13. If we zoom out even further, this is not good, friends and family. This company is just declining. And I gotta say, that high dividend yield just does not make up for the fact that your stock appreciation would be shrinking essentially almost every year. It's not good. This is really surprising coming from Goldman Sachs. My goodness. Let's take a look at the history. The history of their dividend seems to be pretty flat every single quarter since about 2015, 45 cents. And I don't think these are cuts. I think these were special dividends that were thrown on top of the normal one. Yeah, it's right. Because from December to March, in between would be what? January and February, and you got an extra dividend right here. So they were very profitable in 2021, and that's when the interest rate was like what? 0%. So for a BDC, a low interest rate environment, you can see they thrive and they hand out extra candy to you. But in a high interest rate environment and inflation is increasing, they're not doing too well. Well, some of the BDCs were still able to crush it. But in the case of Goldman Sachs, this is not good. I mean, it's flat, so I guess we could say it's a C, considering the high dividend yield seems to be safe. They're not cutting it, and it's not decreasing, even though the price of the stock itself is decreasing. Dividend yield is 14.02%, and the dividend health, I think it's fair to say it's a C. It's not a C+, it's not a C-. So in the case of Goldman Sachs, I think this is a very solid D+ or C- kind of company. I almost feel like I shouldn't put them here. Their NAV per share decreasing year over year. Their share price just on the steady decline, like that's consistent, it's going to decline. Their performance just being really atrocious. I'm sorry, it has to be in the D. I know you're probably very upset with me, but I think the numbers, they don't lie. And the numbers are not in favor of Goldman Sachs. My whole speech about, a boring business, but crushing it in the numbers, yeah, that's the thing you should look for. Like, that whole speech, I feel stupid now. I think their visuals and presentation are very boring and monotone because their numbers are also very bad. And the next BDC is going to be Morgan Stanley Direct Lending, ticker symbol MSDL. Now, just like Goldman Sachs, they have a top-tier parent company, very elite investment banking firm. However, I do want to say this. To speed up the video, we're not going to break down and go into the portfolio sectors and industries because as we just learned with Goldman Sachs, even if you have high exposure to an industry that you think is good, the numbers could still be bad. So let's just allow the numbers to speak for themselves rather than evaluating and judging them based on the businesses that they choose to do business with. Does that make sense? When we take a look at Morgan Stanley's loan mix, about 96% are first lien, which is pretty good. And when we look at all the new loans that are originated right now, about 99% of them are in first lien senior secured loans. Exactly what you want to see, but as we learned with Goldman Sachs, even if you have the best and the most secure loans, your performance could still be crap. Hairy nipples, disgusting. And at this point, I don't even know if it matters, but Morgan Stanley is externally managed. When we take a look at their NAV per share, they've only been publicly traded for a very short time, so there's not a lot of history to work with. But in 2023, it was $20.57. And effectively has been growing in the right trend. And right now you can expect about $20.83 for their NAV per share. So because it's very short, I cannot assume that this trend is going to continue. So I know it's going to sound like a scandal and it sounds stupid, but I am going to give them a C for their NAV per share because we need more data to work with to reach a conclusive outcome of a grade letter. Hopefully their performance is a little better, effectively looking at a year and a half. But let's see what it turns out. The CAGR is essentially 12.64%, which is half that of the S&P 500. Not a lot of data to work with. Like, my first initial reaction is to say this is disgusting, this is horrific, but I do got to be mindful of the fact that that's not a lot of timeline to work with. Let's take a look at Morgan Stanley's dividend situation. The dividend yield, quite juicy. I love that, 10.4%. What's the history? It looks like back in December of 2023, you could expect 60 cents every quarter, and then it went down to 50 cents, and then right here, 50 cents again. This is not a dividend cut. This is a special dividend because in between June and September, which is their quarterly payout, is August. So they do pay a special dividend, but it doesn't take away from the fact that their dividend is now 50 cents, whereas they debuted with a 60-cent dividend. So all in all, I think their dividend is going to be a C for me. I think 10% is good, but had it been growing every year, well, I guess every year and a half for them, then it would have been possibly a B or an A. But the fact that it's not growing, and as a matter of fact, it shrank, I don't know if I can say that's delicious. But they do give a special dividend, so maybe that makes up for the fact that it's not growing. I guess it really depends on how you look at it. So I think all in all, Morgan Stanley is the perfect depiction of what makes a very average BDC. I think they set the tone for it's not very good, but it's not ugly like Oaktree. So Morgan Stanley, a very recognizable, very prestigious financial firm, being C is kind of hilarious. Goldman Sachs being a D, even more funny, but the numbers speak for themselves. We're going to move on to the next BDC. The next BDC is Prospect Capital, ticker symbol PSEC. They are externally managed, and a question that I have for you is, are you sick and tired of hearing my voice yet? I know we promised each other that we're not going to talk about their portfolio breakdown of the businesses they work with, but for a BDC, I do have to call this out. They have a really high exposure to the real estate industry. It makes up about 19% of their loans. And as we all know right now, the real estate industry is absolutely hurting, which is probably going to be yanking on the nipples of Prospect Capital. I'm just making a very educated guess as to what is going to happen when we look at their numbers. When we take a look at their loan mix, about 82% are first lien. Pretty good. It's above that 75% number that we like to see, and they are externally managed. When we take a look at their NAV per share, this is atrocious. This is disgusting. We're just going to move right along to their performance. This is horrific. Their performance in the stock market, not any better. The CAGR is 5.14%. I think this is pretty bad, fellas. If you're thinking about Prospect Capital, I don't know what you're doing, man. Run away. I don't even know you, and I'm trying to tell you, run away. She ain't worth it. She's crazy. NAV per share, I'm not going to be shy about it. It was an F. Let's look at their dividend profile. Their dividend yield right now is 15%. Really high, absolutely juicy. I cannot deny that fact. But as you can see, they currently trade for about $4, which means I'm not a genie in a bottle, but I'm going to go ahead and guess that they used to be like $10 or even $20 a share, and they've just been on a steady decline. Let's see what happened. 5 years, they're down by negative 34%. When we look at max and we zoom out, they're down by negative 71%. They used to trade for about, $14 a share, roughly like maybe even $15, $18. Now they are $4 a share. This is really bad. Anyways, when we take a look at their dividend history, maybe it's better. No. It's not. It's just worse. It just gets worse and worse. It's like committing to watch a movie that has like a Rotten Tomato rating of like a 20%, but you want to defy the odds, give it a chance, and it still ends up being terrible. That's what it is. I mean, I love Adam Sandler. I really do. His newer movies, just saying it. Same with Kevin Hart movies. They're just not good. So that's what it is. It just gets worse as it goes on. It's 15%. I don't care. It's not good. So with Prospect Capital, I think we understand now what makes a BDC an F tier type of BDC. This just, oh my gosh, just ugly. Oaktree, I cannot believe you're better than Prospect, but it is the way it is. Prospect F, Oaktree E. All right, my friend, the next BDC is going to be Sixth Street Specialty Lending, ticker symbol TSLX, and they are externally managed, and what you see on your screen right now are the businesses that they work with. Some big names like Bed Bath & Beyond, Sports Authority, Aeropostale, and if I go to page 28, you can see the breakdown of all the industries within their portfolio. And when we look at their loan mix, about 93% of their loans are first lien, which is pretty good. And when we take a look at Sixth Street's NAV per share, let's see, back in 2014, it was $15.51. Right now, it is $17.12. So in the big picture, it is growing and doing the right thing. And sometimes, yes, it does decrease, but that's during the pandemic. We can give them a pass on that. But going in the right direction, good trend. What about their performance? If we do it to 2015 and we compare it to the S&P 500, $10,000 invested, let's see what's going to happen. Yes, they did beat out the S&P 500 the exact same time period. The CAGR is 14.1%. Their NAV per share, I'm going to go ahead and say something like a B minus, probably even like a C plus. So far, not so bad. And when we take a look at their dividend profile, unfortunately, their dividend yield is just shy of the golden standard of an 8% of being the appropriate dividend yield for a good BDC. 7.28%, but maybe it's because their share price is increasing and it's outpacing the dividend growth. Well, unlike some of the other BDCs that we took a look at today, they were in the red, right? But for 6th Street, they're actually in the green when you just look at the stock price alone. So maybe my thesis there is true. When we take a look at their dividend history visually, I would argue this is a pretty good picture. Do you see these little peaks and valleys? They're not dividend cuts. Because as you can see, they pay every quarter, right? So in between March and June is going to be what? May. And they paid a special dividend here. They paid a special dividend here. So a company that is consistently paying a special dividend, I would argue is pretty good. But when we consider their recent dividend history, it does in fact look like there was a cut, but they rebounded and now they're paying 46 cents. So big picture, 46 cents every 3 months. It started out with 39 cents. It is going in the right direction. I think when it comes to 6th Street, I think this company is not bad. However, they're not delicious either. I think they're the perfect epitome of like a C+. But I definitely think 6th Street is way better than Morgan Stanley. So I think 6th Street should go right here into the B tier. Is that fair? Gladstone, Hercules, and 6th Street, B tier. I think that looks okay. All right, lads, the next BDC is going to be Golub Capital. They have a giant portfolio, over 380 investments. But anyways, the ticker symbol is GBDC. They're externally managed. We take a look at their loan mix. About, what is that? 86% are first lien. That's pretty good. And Golub has heavy, very heavy exposure to software. Whether that's a good or a bad thing, we'll see here in a second. I would argue their NAV per share throughout the years pretty flat. I mean, let's see. 2010, it was $14.71, and now it's $15.19, so it's barely going in the right direction. But what about their performance? So NAV per share, mentally taking a note here, that's a C. Let's see, past 10 years compared with the S&P 500. Let's see what Golub is going to do. They underperformed the market by a whole lot. Their CAGR is 7.83%. Dividend yield, I would say, is pretty decent, pretty juicy. What's the history? That's what I care about. Is it increasing? Is it decreasing? And it looks like they pay on a quarterly schedule. And back in the day, they did pretty well. I mean, they were thriving, but what is going on for the past year? Oh, that looks like it's special dividends. Yeah, these are special dividends. These are not cuts. As you can see right here, their dividend broken down in numbers. I think what's going on, what's really funky about the past year is I think they're crushing it. So they're giving back special dividends to the shareholders. So when it comes to their dividend profile, I think it's pretty decent. I'm going to go ahead and say that's a B. I think Golub, why is this icon so small? Hopefully you guys can see it. I think Golub is, I think it belongs right next to Morgan Stanley as a C. I think that's about as fair as it's going to get for Golub. And now we're going to talk about the heavy-hitting, most popular BDCs. The first of the three is going to be Blue Owl Capital, ticker symbol OBDC. I do want to call out that not too long ago, Blue Owl went through a merger with another BDC within the Blue Owl universe. It's a pretty big financial company because the reasoning is they wanted to consolidate their efforts and financials. Because according to them, they said there was a lot of overlap between the two BDCs and those portfolios, and they wanted to cut down on management fees. In other words, they wanted to reward the shareholders without changing much, except maybe reducing the headcount. So consequently, by combining the two Blue Owl BDCs into one, now they have a bigger market cap, a bigger portfolio to lend out money as one entity. So it's a pretty good thing, and they're externally managed. If you care to see their portfolio breakdown, this is what it looks like. First lien loans, we're talking about 78% after the merger. Can you see how it's very similar? The company that they swallowed up was OBDE, and the one that we're talking about here today is OBDC. Together, 78% first lien loans, pretty good. Anyways, $15.26 back in 2019, and now it's $15.28. It's going in the right direction, but it is pretty flat. I think that's the epitome of a C. And when we take a look at their stock market performance, it looks like this company, because of the mergers, stock splits, and everything else happening, there's not much history to work with. 2019. Let's see why Blue Owl Capital is so popular. So exact same timeline and period with the S&P 500. The year-over-year CAGR, shockingly, it did not beat the S&P 500. As a matter of fact, it underperforms. We're talking about a 10.67% return every year. That's surprising, to say the least. This is weird. I expected a company that is popular to have better numbers, but well, what do you know? I told you in the beginning this video might be controversial. Anyways, their dividend yield is very short of the golden standard of an 8% for a BDC, 6.42%, and the payout frequency is every 3 months. And as we take a look at their payments, what's going on right here? That looks to be a special dividend, those peaks and valleys. But as of recently, let's see what's going on. Oh, that's also a special dividend that's already forecasted and accounted for. So I think their dividend profile is not the worst thing in the world, but it's certainly not delicious either. I think it's what qualifies as a C- because the dividend yield is not high enough and the growth is really modest. When it comes to Blue Owl Capital, I'm kind of surprised why it has such a cult following. It's not as good as I thought. I think this is a very average company. But when I go back to the spreadsheet here, I can see that Blue Owl posted 10.6% year over year. And for Morgan Stanley, a company that we categorized as a C, well, their performance was 12.6%. So I was going to put Blue Owl as a C+, maybe even the B tier, but I don't think I can. I think Blue Owl deserves to be in the C tier. I know, that's the first of the 3 giants. The next 2 are even more popular than Blue Owl, and let's see if they're popular for the right reasons. The next BDC is Hercules Capital, ticker symbol ARK. This is one of the most popular BDCs on the stock market. Even the people who have no idea how to evaluate a BDC, they know what Hercules Capital is. And when we take a look at their portfolio breakdown, that's what it looks like. Hercules Capital is externally managed, and when it comes to their NAV per share, it seems like it's kind of all over the place, but when you think about it big picture, it is going in the right direction. $19.77 NAV per share as of recently. Started out in 2005 as $14.96. This drop right here, this valley was the Great Recession, and then this drop right here was the pandemic. So it seems like, and when times get hard and there's obstacles, their clients struggle, and so do the profitability of Hercules Capital, and it's reflective in their NAV per share. But when we take into consideration those financial catastrophic events and how they were able to rebound right away, I think we do got to give points where points are due. So when it comes to their NAV per share, I mean, I hate to see the fact that there were drops during those disasters, but they do recover quite nicely. So I think their NAV per share for me is going to be a B. And when we look at the past 10 years, stock market performance for ARK, let's see what's happening here. Their year-over-year CAGR did, in fact, beat out the S&P 500 at 14.4%. This is good. I like what I see. And in the past 5 years, stock appreciation alone, it went up by 24% and went from $18.90 to what it is today of $23. So the stock price is appreciating, but what about the dividend? Is that appreciating? Dividend yield is just above the golden standard of 8%. That's a good thing. Let's see what's happening with the dividend picture. Yes, this is beautiful. I mean, I think that's an outlier right there. 38 cents every quarter. It's increasing. And then after 2023, it's just been flat. But for the most part, it is going in the right direction. It is growing, and the yield is just above that magical 8% number. So I think when it comes to their dividend, I think it's a B as well. So I know this sounds very controversial because 2 of the 3 metrics were a B tier. I thought their performance was pretty darn good. I think it's like a B plus or even like an A minus in terms of their CAGR. So I don't know exactly where to put ARK. Now remember, I don't have any skin in the game. I don't own any shares of it. I don't have any bias. But if it were up to me based on what I saw, I think ARK is a very solid B tier BDC. I can see why people like it, but there wasn't anything for me to be in love with it, to say this is beautiful, a delicious dividend compounder with cheese. So I think Ares is a very solid B+. I wish I could put a note here that says B+, not actually B, but I don't think Ares belongs here in the A tier. As a matter of fact, I'm going to take that back because that's why I made this spreadsheet, because my mind can go all over the place when we're talking about 15 freaking companies in one video. Who does that? I've been filming for almost 3 hours now. Trinity Capital was a B for their dividend health, B for the NAV per share, and the CAGR of 14% is pretty similar to ARK. So I think that's going to bump them up to the A tier. If we thought Trinity was in the A tier, then there's no way that Ares is also not in the A tier. And that's why it's good to make a benchmark standardized thing like this so you can reference. I'm such an idiot. I take back what I said. Because Trinity's dividend yield is 13.3%, I don't think I can bump up ARK just because of the CAGRs being similar, because their dividend yield is an 8.1%. It's just barely above the 8% minimum standard. Consequently, I already know you're going to click dislike on this video, but I think Ares must be bumped down to the B tier. A very solid B+, but they just missed the mark. And last but not least, the most popular and the favorite among the dividend community is going to be Main Street Capital. Ticker symbol MAIN. Now, Main Street is very unique as a BDC because to me, I would categorize and label them as a growth BDC. You're not just expecting your total return, 90% of it to come from the dividend yield. You also expect their share price to appreciate. So it's unique in that factor, but they also pay a monthly dividend. And every so often, they also pay a special dividend. So in one calendar year of 12 months, you can expect 14 to maybe even 16 dividend payments. So Main Street Capital, to me, is kind of like the equivalent of Realty Income Corporation or Agree Realty, ticker symbol ADC. So Main Street popular for all the right reasons. Case in point, when we take a look at their share appreciation for the past 5 years, look at this. It went up by 42%. It traded for about $40 back in 2020. Now it's $61. I would even argue it's trading for a premium and overvalued, because when I take a look at their NAV and their book value, it's trading for a premium at about 94% above it, which you want to see as a company that's trading around, 1% or even 2% above it. But to be about 2 times the price that it should be tells me that Main Street Capital is really a premium BDC with very high expectations. Their NAV is $31.65. They're trading for almost double that price. For example, very quickly, when you think about ARK, Ares Capital, their book value is $19.77. Right now, they're trading for about $23, which means they're trading for a premium of about 18% to their book value. So Main Street Capital, I would argue, out of this entire list is probably the most, it's the most expensive when you look at it from the traditional PE ratio from a normal company. Likewise, when it comes to a REIT, you look at their price to AFFO. So for a BDC, you look at it with the book value. And what's crazy is when you look at the Wall Street analysts, they believe that Main Street Capital should be worth about $48 a share. So even in the eyes of Wall Street, Main Street Capital is just way too overvalued if you care at all about price predictions and forecasts based on their numbers. So at their current trading price, it's a decline of 21% if they were to drop back down to their intrinsic valuation of $48 a share. Anyways, let's look at their dividend profile. Dividend yield, really low. I hate to see it. It's a 6.2%, but what's the history of it? Wow, that's a very long history. As you can see right here, these peaks and valleys are special dividends that are handed out to them. They are not cuts. And as we take a look at 2022, you can see there's a lot of peaks and valleys here, right? So on the March the 1st is their regular monthly dividend. And then on March 21st, they also paid out a special dividend. And then likewise, it's the exact same thing again and again. So this is a company that you can expect, multiple dividend payments even on the same month. That's actually a really cool thing to see. So when it comes to Main Street Capital's dividend health, the yield is not good, but the health of it and the growth, I would argue, is an A. Absolutely beautiful picture to see. And friends and family, when we take a look at their NAV per share, this is nothing short of spectacular. Yes, during the Great Recession, there was a slight dip. And yes, during the pandemic, there was a slight dip. But look at this growth of the assets that they have on hand, the loans, the equity stakes. This is beautiful. I would argue this is an A. And when we take a look at their performance in the stock market, I think it's also going to be spectacular. Let's check. Main Street Capital's year-over-year CAGR is 16.3%. Friends and family, I think Main Street Capital is popular for a very good reason. 16.3%. I would argue this is probably one of the best companies that we have seen here today. And I think Main Street Capital trades at a premium for a good reason. It is just phenomenal. However, their dividend yield is shy of that 8% number. So I think we're going to go ahead and put them right here next to Ares, the two popular ones. They can be married together, hip to hip. I'm just kidding. I'm absolutely an idiot, but I know good when I see good. And I think Main Street Capital is better than good. I think this is the definition of an S tier. I think they belong right next to Blackstone secured lending. Because when I reference my spreadsheet that I made, they also exhibited an A for their dividend health, an A for their NAV per share, but Blackstone's CAGR, 28%. My goodness, that is crazy. And the dividend yield was 9%. So I would argue, I know this is crazy, I would argue that Blackstone is better than Main Street, but I think they're both really good and they're head over shoulders above the competition, no doubt in my mind. So my question to you is, if you made it to the end of this video, do you think my ranking list is all sorts of jacked up? Or do you agree with how I rated and graded the companies? Which ones are you eyeballing? And as you type out your response to my question in the comments section, are these picks risky? Are BDCs inherently risky? I talked about it a few times in the video, but I wanted to give my real answer. BDCs are risky, yes and no. It's the same way that I look at Bank of America, Evercore, and even JP Morgan Chase. Financial institutions inherently carry more risk because their business model revolves around loans, debt, acquisitions, and leverage. But as we learned throughout this video, if it's properly managed, I do not think the risk is too bad. And because of this methodology and what we learned here today, I'm personally going to be adding Blackstone, Capital Southwest, and Trinity Capital to my watch list moving forward. The reason why I didn't say Main Street Capital is because he's been on there for a while and I've just been waiting for a good price. My personal buy price for Main Street is whenever it dips below 40 bucks. And I'll tell you what, I don't know if that's going to happen anytime soon. It could, maybe 3 or 6 months from now, but in the short term, I don't see that happening. For Blackstone and Capital Southwest and Trinity, I see more value in them because they're not overpriced yet. And I feel like if I buy into them now or at my buy prices, I think I can get a better deal and a better rate of return. But anyways, with that said, I love you guys. Thanks for watching the video all the way through. Stay safe and I'll talk to you next time. Peace.